Now coming to the canteen recovery. So this is one of the issue which has assumed a lot of dispute, even though in our view the disputes do not exist. But again, due to uh, certain advanced rulings, these disputes have come up. This is an issue which has attained multiple dimensions in the recent times, starting with whether ITC is available or not. Secondly, whether it constitutes a supply from employer to employee. And thirdly, if employer is making some recovery on account of that, on what value GST is payable. So we thought that for the benefit of participants, we'll cover this issue holistically. So starting with the transaction is that a company engages a contractor who provides canteen services in the company's premises or factory premises, etc. So the contractor will charge 5% GST on its invoice. Those canteen facilities availed by employees. In some cases, it is free. In some cases, recovery is made. So say, for example, out of 100, the company is making a recovery of 30. So the question number one is whether ITC is eligible on GST charged by canteen contractor. Secondly, whatever recovery company has made, one, whether it's exigible to GST. Second, if yes, whether GST is payable on 30 or any other value. So before this session, we run a poll as to what is audience view, whether ITC is admissible on these canteen expenses if it's incurred by a factory. So 66% audience felt that it is available, whereas rest felt it is not available. So let's see what's the correct picture. So as far as input tax credit is concerned, Section 17(5) lists down goods and services on which ITC is not available. So one of the restriction is food, beverages, and outdoor catering. So at first place, you will see that, oh, outdoor catering is ineligible for credit. Health services, life health insurance, leasing of motor vehicle, all these are excluded. On these, including canteen, ITC is allowed only when it is used for making an output supply of same category. So in our context, what it means is that if I'm a canteen contractor and I in turn avail canteen services or I subcontract it to someone else, only in that situation I'll be allowed credit because I'm using it for making output supply of same category. Then in that clause, membership of health club and fitness center is also excluded, and travel benefits extended to employees is excluded. So this is a whole clause which is 17(5)(b). Now, when the GST was introduced from July 2017, that's how this clause looked like. Then a lot of representations went to GST Council that especially these canteen, etc., for factories having more than 250 employees, it's a statutory obligation. Therefore, ITC should be available. GST Council deliberated this issue extensively and brought an amendment effective February 1, 2019, stating that on these goods and services, ITC is available when it is obligatory under law. And the GST Council minutes also clearly indicate to that effect. So in our view, both the way law is drafted as well as from an objective perspective also, ITC on canteen is available only in a situation where there is a statutory obligation. Statutory obligation in our context will be for a company or for a canteen, which is canteen facility which is provided in a factory covered under Factories Act, meaning more than 250 employees. In no other situation, ITC on canteen services will be available, say, for example, offices, or where number of employees are less than 250. And let's see how the recent rulings have come out. So the recent ruling is in case of Tata Motors. So Tata Motors has held that this proviso of statutory obligation which has been introduced should be read with the last clause, which you saw in the previous slide, which related to travel benefit extended to employees. And therefore, ITC is not available. In our view, this ruling is absolutely incorrect. The way this proviso has been introduced, it will cover all the clauses. So any of those goods and services, be it outdoor catering, be it travel benefit, as long as there is a statutory obligation to do that, those will be eligible for ITC. And secondly, as I mentioned, from a purpose perspective also, this amendment has been made to allow ITC on expenses like canteen only. But similar to Tata Motors, there was a ruling, another recent ruling in case of Musashi Auto also, where they held that ITC is not available. The second aspect comes in that when an employer provides canteen facility to its employees, first situation can be he doesn't make any recovery. Entire expenses are borne by the employer only. So in that case, as far as Schedule 2 is concerned, wherever there is a supply of employment services. So this is what it says by an employer to employee, sorry, by an employee to employer in relation to employment. So as an employee, whatever I'm doing from my employer, it does not constitute a supply. So when GST came up, this ambiguity was there in minds of many taxpayers. And there was a press release from the government also that whatever facility employer is providing to employee in terms of contractual agreement, that will be outside the purview of GST. So if in terms of my appointment letter to my employee, I'm saying that canteen facility is available, or in terms of a HR policy, it is available, then it's a contractual agreement from employer perspective. Therefore, there is no supply per se. So in a situation where there is no recovery, there is no supply. It's a perquisite to the employee. So it is not a supply nor any GST is applicable. Now let's consider a situation where there is a part recovery, or say there is a full recovery. Now, let's first discuss how these recent rulings have dealt with the issue. So the recent rulings, firstly on the taxability part, they have held that employer is not getting any profit margin from the employees. It is collecting on an actual basis only. The rulings held that this is an activity without consideration and GST is not payable. So these are the rulings in case of Tata Motors and Dishman Carbogen. And recent rulings and similar rulings were also passed by Maharashtra AR, UP AR in multiple cases where they held that if an employer is making recovery for medical insurance facility for employees, parents, etc., it is not a supply. So in our view, where there is a recovery, there is a supply to the extent of recovery only, because it's an activity done by the employer in the course or furtherance of business only. Therefore, the taxability exists where recovery happens. So again, in our view, even these rulings are incorrect in holding that these transactions are not taxable per se. Now, the next question comes up is on the valuation, that suppose if I incurred a cost of 100 and I recover 30 rupees from the employee, then what happens? So rule 28 of CGST rules deals with the valuation. It says the valuation should be open market value, which is money value of such supply at same point of time between unrelated parties and where price is sole consideration. If OMV is not available, value of goods or services of like kind and quality. Otherwise, you go to rule 30 or 31. So the next confusion which exists in the mind of industry is that if I'm incurring expense of 100 and recovering 30 rupees from my employee, then whether GST is payable on 30, or because my original cost was 100, therefore OMV becomes 100, so GST is payable on 100 only. So in our view, we should see this transaction in two parts. As part of my employment engagement, I told the employee that I will provide you food at a subsidized cost. So 70 rupees cost will be borne by me. So as we discussed few minutes back, that's a facility which I'm providing as an employer. And even the government's press release clarified that whatever facility is provided by employer in the course of employment, that's outside the purview of GST. Therefore, in our view, the first part of transaction, that is 70 rupees, which is a cost borne by the employer, that's outside the purview of GST. On the second part, to the extent I am making recovery, I'm making recovery of 30 rupees. So to that extent, the OMV of that transaction is also 30 rupees. Therefore, in our view, GST should be paid on 30 only. So to summarize, there can be three situations: no recovery, full recovery, and partial recovery from employees. As far as ITC is concerned, if there's no recovery, it's fully eligible. We are presupposing that there is a statutory obligation. If there is a full or partial recovery, then because the rate of GST is 5%, which is subject to ITC reversals because it is treated at par with uh, exempted supply. Therefore, pro rata reversal under Rule 42 is needed. But yes, step by step, in case of full and partial recovery, employer will be entitled for full ITC and he needs to make pro rata reversals. On taxability, if there is no recovery, not taxable. If full recovery, in our example, he should pay tax on 100 only. And if it's a partial recovery, then whatever is recovered. So in our example, if we recovered 30 rupees, GST is payable on 30. So with this, we go to the next part, which is other rulings. So my colleague Anshika will be taking it further. Over to you, Anshika.
Thank you, Vineet. So coming to other rulings, in case of Prakash Mica Exports, the refund claim that had been filed by the petitioner had been rejected. Pursuant to this rejection, an order for recredit had been made in Form PMT-03. Though the order had been passed, however, the amount had not been recredited to petitioner's ECL. As a result, the petitioner was aggrieved and filed a writ petition seeking recredit of this amount along with interest. While this writ petition was pending before the High Court, the principal amount was recredited. However, interest was not credited to petitioner's ECL. So the limited dispute that remained was whether interest is payable on the amount which was delayed in which the department delayed in recrediting. The respondent, that is the departmental authorities, held that if the petitioner was aggrieved by the amount that was recredited, he should have filed a form PMT-04, which relates to grievance or discrepancy in ECL. However, no such form was filed by the petitioner. The court took note of submissions made by both the parties and it held that the respondent's contention that PMT-04 is to be filed is devoid of any merits. The cause of action in this case had arisen, that is, the interest was liable to be paid only because there was a delay caused by the departmental authorities in recrediting the amount. Observing this, the court directed the petitioner to file a representation before the respondent, that is the department, and the respondent must pass appropriate orders in accordance with law. In our view, this ruling is incorrect to the extent that it has failed to appreciate that PMT-04 is required to be filed only when there is a discrepancy in ECL. When interest has not been credited, there is no discrepancy per se, so it will not fall within the ambit where PMT-04 is required to be filed. Further, the court failed to appreciate the point that There is no statutory interest which lies here. The interest here will only be granted only on the grounds of equity. So these two were the anomalies in this particular order. Coming to the second ruling, that is in case of SCV Sky Vision. So here the applicant is a cable service operator, and he entered into a business transfer agreement with a purchaser who was engaged in similar services. In terms of the business transfer agreement, he transferred the entire business, including rights, titles, etc. However, the employees and the liabilities were not transferred. The question before the AR was whether this falls within the ambit of services by the way of transfer of going concern and hence eligible for exemption in terms of the notification. The AR held that a transfer of business as a going concern can be held only if the transferred business is capable of running independently. Here, the liabilities had not been transferred, which was a mandate for it to be transferred as a going concern, and only the rights, titles, etc., assets had been transferred. So that is why the business was not capable of being run, and these did not constitute transfer of business as a going concern. GST was paid. In our view, this ruling is again incorrect. Non-transfer of liabilities does not hamper or affect the continuity of a business. The business is still capable of being run independently. And in this case, it was actually services by way of transfer of going concern and eligible for exemption under the notification. Coming to the third ruling, in case of World Economic Forum, India, there was an overseas head office which was providing HR support, IT support, and management support of services to the liaison office. The liaison office did not pay any consideration to the head office for providing these services. Further, the liaison office had been established in terms of the RBI guidelines, which restrict a liaison office to undertake any business or commercial activities. The question before the AR was whether the head office whether the services provided by the head office constitute supply under GST or not. The AR observed that the activities which were undertaken by the head office were for setting up an administration of liaison office. There was no activity by the liaison office which would constitute business per se within the definition of CGST Act. So these activities not being in the course or furtherance of business were outside the ambit of Schedule 1 itself. Thus, these were not supplied. In our view, this is again incorrect. In our view, this ruling is correct. And there have been ample rulings earlier also where it has been held that activities of liaison office do not constitute a supply. These rulings are in case of Taco Holding, Fraunhofer and all. So this issue is more or less settled by till now. The next ruling is in case of Inox Air Products. In this case, the applicant was engaged in supply of industrial gases. For that purpose, it entered into an agreement with Indian Piston Limited for a grant of lease land rights for setting up of an air separation units. The question before the AR was whether ITC will be admissible on the GST charged by Indian Piston Limited. The AR held that Section 17(5) of CGST bars ITC on procurement of construction of immovable property except plant and machinery. Here, the air separation unit might form a plant and machinery, but the lease land rights do not form plant and machinery and they are in relation to construction of immovable property. Accordingly, no ITC will be admissible on these. In our view, this ruling is again incorrect. So 17(5) bars credit on those expenses which have a direct nexus with the construction activity. These could be labor, raw materials, etc. Lease rights they do not have a direct nexus, but actually an indirect nexus with the construction activity, and thus ITC would be admissible on these rights. Coming to next ruling, in case of Varja Cooperative Bank in Vago, the applicant was incurring expenditure on various supplies while constructing a new building. These were air conditioning system, lift, electrical fittings, roof solar plant. fire safety extinguishers, ventilation system, interior designing and architect services, locker facility, etc. The question before the AR was whether ITC will be admissible on all these supplies or not. The AR held that the supplies such as air conditioning system, lift, electrical fittings, etc., these are not capable of being shifted from one place to another without dismantling them. Due to this reason, they were immovable property and ITC was not admissible on these. Similarly, services like architect and interior designing services, these were procured for construction of immovable property. Accordingly, no ITC would be admissible. Lastly, locker, cabinet, and generator. These were movable in nature and ITC would be admissible. In our view, this ruling is also incorrect as it fails to appreciate that the aspect of plant and machinery and immovable property are not mutually exclusive. It can always be a situation that an immovable property, if it forms a plant and machinery, then it is outside the ambit of 17.5. In our view, air conditioning system, lift, electrical fittings, roof, solar plant, fire safety extinguishers, and ventilation system. These all are plant and machinery, and hence ITC would be admissible on all these. Coming to the next ruling in case of Suvikram Plastics. So in this particular ruling, the appellant had transitioned the credit of secondary and higher education cess and education cess to GST regime. The department had issued show cause notice for recovery of these amounts along with interest and penalty. The tribunal held that these cesses could not be transitioned to GST regime. It had placed reliance upon Sutherland Global Services, and accordingly, these amounts were recoverable from the appellant. In our case, the sanctity of the Sutherland Global Services itself is challengeable, and the judgment is easily distinguishable for the reasons that it fails to appreciate that there is no provision for lapsing of a particular credit. So, in the absence of any provision for lapsing of credit, there is no restriction where the credit of cesses could not be transitioned. Further, the transitional provisions under GST, that is section 141 or 14008, they again do not bar transition of these cesses particularly, and accordingly, these could have been easily transitioned in the GST regime. The third point is that the recovery provisions under erstwhile laws, that is SENVAT credit rules, or for that matter GST laws, it does not provide for recovery of transitional credit. Due to the absence of a main machinery or the substantive law itself, no recoveries can be made. To that extent, this ruling is incorrect.
Thank you, Anshika, for covering the rulings. Now, if we have to summarize today's session, so restriction in filing of GST were one enabled on GST portal, very important both from suppliers and recipient perspective. Rate of GST on auto parts, its next big litigation likely to come up. Rates of road tip scheme grossly inadequate, and a lot of representations going and likely to go on increasing the rates, increasing coverage of sectors, increasing type of units, ITC on canteen expenses. A straightforward issue, but due to couple of adverse advanced rulings, again likely to be disputed. ITC on construction related expenses, multiple aspects, what qualifies as plant and machinery has been grossly overlooked in multiple advanced rulings, whether the expenses have a direct nexus with construction or not. And lastly, transition of cess credit continues to haunt the taxpayers where these were legally transitionable. So with this, we come to end of today's session, and thank you for joining in large number. Take care.